Welcome to the Edified Equity Podcast. My name is Dino, where here we focus on all the unique benefits associated with being a passive equity investor in an apartment syndication. Today on the Edified Equity Podcast number 71, I have Mr. Jay Goldblatt of Madison Trust Company, and we're going to be discussing and learning from Jay all about IRA investing. So before we get into it, I want to just, like I always start off with, say, if you're the first time tuning in here, you can learn more about and follow us on the web, iTunes, Stitcher, Facebook, YouTube, Twitter, LinkedIn, Instagram, and our award-winning blog on biggerpockets. All associated links are going to be in the show notes. If you find this information helpful, please subscribe, like, comment, rate, and review. All right, Jay, I want to officially welcome you to the show.
Thank you, Dino. It's such a pleasure to be here. I really appreciate your asking me to come on. It's a big honor, and I think I've learned so much about what you've accomplished and what you do that, I'm very happy to share with whatever I can give to your audience.
Yeah, well, thank you. We appreciate you being here because as we're going to learn today, there's a lot of money. I don't want to give out the specs. I want to let the expert do all of that for us. But there's a ton of money trapped in IRAs. And some of this money is literally just sitting there. Sometimes people aren't aware the money's there. There's all types of, little like pathways we can take on how to take this conversation. But the point I'm trying to make is alternative investments are, in my opinion, especially when we talk about multifamily, owning an apartment complex is something that people, I don't think they think about it because they're like, it's not me. I don't have enough money to buy it. It's owned maybe by a big corporation or this one rich person or rich family or something. And they don't realize that actually they can be a part of and be a part owner, an actual owner, because they share equity in the investment. And then the other thing, so they don't realize that, number one. I mean, I say all the time, the number one reason people aren't investing into apartments is because they don't know that they can. That is just not the case. And then the other reason, they might not think that they have disposable funds. And again, as we're going to learn today, that might not be the case. So if we can shed light and educate my audience, like I said in the intro, they are all about people learning not to invest with me. We don't, this is, of course, we're not going to violate the SEC. We don't pitch deals here. It's strictly about giving and educating people about this alternative asset class, the roadblocks, the red flags, the good, the bad, and the ugly, if you will. And in today's episode, I'm so excited to have them learn about this is kind of like a little hidden gem. In addition to the alternative investment being hidden, this type of fund isn't widely used.
Exactly. No, you're absolutely right. It's a pleasure. I'm glad you're onto it because it's definitely one of the unknowns that I think we can teach a lot of people to benefit from, and it'd be my pleasure. So.
Okay, well, Jay, great. I'm ready to hop into it. If you want to go ahead and give a little background about yourself or hop right into the presentation.
Sure.
It's yours.
Thank you. Thank you so much. I appreciate it. So I can just tell you briefly about myself, where we have, I guess I can tell you, I've been at Madison Trust here for about a year. But before that, I was with our sister company. The sister company is called Broad Financial. And Broad Financial and Madison Trust both have the same approach in that we're dealing with self-directed IRAs and self-directed accounts. And we're going to explain what self-directed means. But long story short, I've basically been in the industry about 8 years. So I've seen a lot, and I've talked to about, can you imagine, 10,000 people individually. I've dealt with about 10,000 different people, retail investors, helping them get into alternative investments. So it's been quite a run. I've really enjoyed it, and I'd love to share. I think I have this video here. I can share the slides that I have put up, and let me Let's get the screen right here. There we go. So here we go. So this is Madison Trust investing your in real estate with your IRA. So I can tell you just a little bit about myself that as I left my father's business and went into different things, ultimately I felt that the financial services was really the best place I could use my talent and still help people. And I was approached by the owner here, and haven't looked back since. It's been a great opportunity, and so happy I've helped so many people. The neat thing about Madison is that we can do so much more on such a bigger level, and that I want to get into. So investing into real estate with your IRA. So just as a disclaimer, as Dino already said, we're not offering investment advice. We're not offering any kind of tax or legal advice, but it is information I do want to share and make sure everyone has this. The thing I like to start with is why alternative investments, because it's kind of the unknown. We just like you said, Dino, we're kind of in a niche market of investments with multifamily, or some people get into self-storage or in the lending business. So I think it's important to know that alternative investments are really things that are not some wild, crazy, unknown thing. It's really a normal, regular investment that happens to be different than the stocks, bonds, and mutual funds that most people are used to.
Right.
So that that's an important point. An alternative would just mean usually real estate, or maybe a lending platform, things like that. But for the most part, it does not have to be wild and out there. And it's not so much for the the super high net worth and elite investors. It's actually for everyday investors as well. So how can we see the argument that that's really where everyone should consider? So one way to look at it is through what are the big boys doing? What are the big companies doing, like BlackRock and all the others? Well, they are moving toward alternative investments, and that's something here that we can see a trend. If you look at the graph, it's definitely trending up. There's no downturn. It is going higher and higher and higher into alternative investments. So that TN is for trillion.
Yeah.
And that's all the money going into alternative investments themselves. And you mentioned a point as well, that there are a tremendous amount of retirement funds available. So I can tell you the statistics lately. The latest one I've seen is that it's around 9 trillion in just IRA money. So IRA money versus 401k, meaning an IRA is something that you've either taken from a previous job and put it into an IRA, or you've built it up over time into an IRA yourself, an individual retirement account, but not a 401k, meaning 401k is at a job, you work for IBM or wherever you work, and that's a 401k at that job, retirement plan at that job. But just in IRA money, there's $9 trillion, and that's available. That means anyone could move that money from wherever it is, Fidelity, Vanguard, TD Ameritrade, and move it into a self-directed IRA account, and then invest as they see fit wherever they want to put it. And that's very empowering. It's a tremendous opportunity. So the trend is happening. People are doing it, and there's a ton of money that people could put into it.
Mm-hmm.
So let's define, what do we mean by self-directed IRA? A self-directed IRA is essentially just like any other IRA. It has the same rules. the government has rules on these things. The difference is that it focuses on alternative investments. That's really essentially what it's doing. It's investing in, like we said, real estate, notes, and private placements. So that is what a self-directed IRA is. Now, you may find that brokerages may call their IRA on their platform self-directed, like a Vanguard or TD Ameritrade. They might say this is self-directed, but don't be fooled, because they kind of co-opted the name. It really means that they're able to pick certain stocks. That's really all the main difference in
Right.
that. It's not completely self-directed, 100% self-directed, which means you could do all the above. So the benefits that I like to say are mainly diversification. And there's a very important tool that is used when determining how to diversify. It's called the modern portfolio theory. And what that says is that if you take, let's say, 20% of a regular portfolio, let's just say it's $100, and you want to take $20 and put it toward alternative investments. If you did that, the modern portfolio theory says that risk-adjusted returns, meaning all things being equal, there's risk everywhere, but if you level out all the risk and you say, okay, based on all the factors, this is the same type of investment strategy and risk. If you could have that 20% into the portfolio, that means your return is going to be higher. It's almost a guarantee. So again, if you have stocks, bonds, and mutual funds, $100 of that, let's say it gets 8% return, just an example. And if you get a 20% of alternative assets into this same portfolio, and you switch it out for the stocks, bonds, and mutual funds, then instead of an 8% return, you could possibly get a 10% or 12%. It shows the difference in potential in that. So that diversification, very important. Alternative investments are not tied to the stock market. So some people might say, well, Jay or Dino, I'll just get a REIT.
Yeah.
I'll just buy a REIT. I don't need to, get into all these, specific investments. I'll just get a REIT. Well, a REIT, a traded REIT, is actually tied, very correlated to the stock market. And that has been proven, again, by analysts that show this. So the main thing is, I'd say at the end, you're in control. This is your money. It's not anyone else's. You decide where you want to put it. Mm-hmm. We're certainly giving you the opportunity to diversify and not be tied wholly to the stock market. Some people are diversified. It just depends on what you mean by that. Some people have hopes, wishes, dreams. But it's hopefully no one watching here is like this.
Right.
So I think a really good way to describe what a self-directed IRA is and how it works is to use an example. A perfect example is the president of the company here, Mr. Daniel Gleish. He's a fantastic person, and his father trusts him with his IRA years ago, and it's a great story. He basically wasn't doing well for whatever reason. His father had the broker, and the broker just wasn't doing well. He wasn't up, wasn't down. Maybe he was losing money. He had enough. Mm-hmm. So he said, to Danny, he said, look, my broker's not doing so well with this money. Let's see what you can do with it. You're good in real estate. So he says, fine. I have to look. I don't know. It's an IRA. I've never dealt with that. So let me see what I can do. So he looks and finds out that this is an actual possibility to use a self-directed IRA. Long story short, he does that and makes a modest return that's positive, and does that for a few years, and his dad's thrilled. Well, the light bulb went off, and Mr. Gleish ended up obviously making more out of it with Broad Financial and Madison Trust.
Mm-hmm.
Another story I like to tell is, personally, this happened when I was working for Broad. There was a nice couple that had called me and said, Jay, it's been, our account's been flat for about 10 years. Can you imagine? I mean, there's cycles. There's cycles, there's ups, there's downs and everything, but after 10 years, nothing happened.
Right.
So, and they just, they were tired of it. So they said, we want to do something different. We want to get into real estate. We have ideas. We just don't know how to use the retirement money. So I showed them, a way that would work for them, and they decided to go for it. Well, a year later, they called me back, and the wife was thrilled. She said, "You can't imagine, we're making money. We're actually doing well," and she was so happy. And it's gratifying to me to hear those stories, because, it's empowering. It's very empowering to have this ability to self-direct. Now, some people might ask, well, can I only do it with my traditional IRA? And the answer is no. You could do it with all kinds of IRAs. That's no problem at all. And this is a very important point. Can I roll over a 401k from a previous employer? A lot of people, and I'm not sure why, it's just our nature, our human nature. We want to just kind of leave things where they are.
Right.
We don't want to change. We're afraid. We don't know enough, whatever it is. So I know many, many people, they leave the 401k where it was, even though they left the job and they're not tied to that company anymore. They just left it there because it's there. At least I know it's there. And they've been doing okay, and, that's it. But here, what you can do, you can actually empower yourself and move over some or all of that money into an IRA that, it doesn't have to be all alternatives, but you can choose to make something happen with that. Now, many people are questioning, whether it's possible or legal to actually buy real estate with my IRA. It can't be, and the truth is, though, that it is allowed. There's no problem with it. The IRS has already gone through this many, many times. The main question, though, would be with things you cannot do, and they do have rules. The things you cannot do are life insurance or collectibles. And so those are important, like baseball cards. You can't do that, or, buy life insurance. Now, another reason, and I think this is why it's so important for your audience to hear this, Dino. I'm a bit of a self-directed IRA evangelist. I want everybody in the world to have this. It's like it means so much that here's the thing. I've heard probably every conversation, almost every, let's say 95% of those conversations that I've had with individuals. We talk about the options. We show them what they're able to do. They make the decision, yes or no. It's fine either way. But the main question that comes out of it usually, Jay, how come nobody ever told me this before? I had to Google this and search for you and find you, and I don't understand. Why is this such a secret?
Right.
So I've told people, I said, look, we're telling as many people as we can, but I think the main reason is that accountants, financial advisors, attorneys really don't have anything to do with it. It's not their realm. It's a niche. And I think that, some also in a different sense, they're not going to gain anything from it.
Right.
It's a specific knowledge base. And by not getting any financial benefit, there's no motivation to help anyone. But I think it's turning, Dino. I think really the tide is turning. And as you saw from the graph, alternatives are becoming more important. And as they become more important, more people will want to get into them. And I think they'll want to do that with their IRAs more. Mm-hmm. Now, having a comfortable retirement is very important. But hopefully everyone here will be more comfortable than that.
Yeah.
So how do you actually do it? Okay, that's probably the next question everyone's asking. Okay, fine. I like real estate. I want my IRA to go into it. How do I do this? So the next thing you do is you set up with a self-directed IRA custodian, and there are several out there. So you can set up either a traditional IRA or a Roth IRA or whatever kind you want. Set up the beneficiary. Then the second step would be moving money into the IRA, the new IRA. So in other words, it comes from the Vanguard, Fidelity, Schwab, and goes into the new self-directed IRA custodian account. Or if you have the 401k at the old job, so then again, the money will flow from there into the new IRA, but this time the investor would actually move it themselves. They would tell the 401k, move it please into the custodian's IRA. And the difference is whereas the IRA transfer, it would be the IRA custodian talking to the previous custodian and pulling the funds over on behalf of the client. Just a technical difference there.
Mm-hmm.
Now the fun part is step 3. That is actually investing the money into something you want. And that's really exciting because now you're actually getting into something that you've researched, you believe in, and you feel confident in the opportunity. So you can do that. And that's what the custodian will do. They will send the money in at your behest. And the titling is not too complicated. It's really just the custodian name and the person's name and their account number. The cost is a very important thing because ultimately that cost, depending on how much it is, it's an expense. An expense is a drag on profits. As you know, Dino, in all your multifamily acquisitions, expenses and costs are key. To keep your profits high, you've got to make sure you're not spending what you don't need to spend. So same thing here. I mean, there are 2 types of custodians. One is an asset-based, meaning similar to a financial advisor, however much money you have, that's how much they're going to charge you, a percentage. The other kind is a flat rate. Flat rate is basically a fee for service. It's just a setup fee and a quarterly fee as well. So the process would be, it would be about a 2 to 3 week process in general. It can be faster. There are ways to make it faster, meaning by wiring or expediting. The other way that it could be longer is that depending on the place it's coming from. So there are custodians that are like insurance companies, okay, and they have a labyrinth of requirements that you have to sift through to get get your hands on your own money and pull it out of there. And it's really not easy, but they will take longer. Insurance companies, in my experience, generally that's what it is. Now, okay, so you want to get some real estate or some alternative investment. You want to get a self-directed IRA, and you got an idea of the different types that are there. Well, how do I choose? Like, I don't know anybody. How am I supposed to know what custodian is good? I mean, it's not like I can, you find one on the corner. It's not like, I can choose between a bank that I have an experience with. I've never experienced this before. So how do I choose someone?
Right.
So that's very important. And I think the answer to the question, I would probably switch these in order. I would probably, and this is probably where most people go anyway. They look at the reviews. They see what kind of company are they from the outside. What are people saying about them? And, what are their strengths? What are their positives? Have they had any challenges? What are their issues? These are all things that you want to look into when you're looking at reviews. And then, of course, their fees. You want to know how much they're going to cost and which model they're basing it on. You want to ask that question. And then, of course, the service and support. You want to know what am I paying for here exactly, and what are you going to give me in return? So that's a very important thing. And then we talked about the time frames. That's also important to know, how much time it's going to take. So that's a good briefer on a brief discussion on self-directed IRAs, and I would love to answer any questions that you have, Dino, about them.
Yeah, sure. So, I mean, one of the things is, there's nine. I mean, this is actually just listening to the presentation and having done this personally myself. It it's not a difficult or complicated process. Like you said, you might run into a little bit of friction when you're trying to access your own funds so that you can self-direct, meaning do what you actually want to do with the money you saved. But other than that, it's a pretty smooth process. And even that obstacle's not too difficult. I mean, I basically had to say when they were throwing up some red flags, or not red flags was not the right word. They were giving me some friction. Let's leave it at that. And say,
Mm.
I had to say, look, I understand that you are saying you're not sure if this alternative investment is going to be okay with the IRS, but that's for them to decide. In other words,
Mm.
let me pay those consequences. And it was real estate. So I knew the rules, but again, maybe
Mm.
they probably have this protocol to put up a little bit of fight. So more people would just say, oh, it is difficult or whatever, and they back out. But other than that, I mean, 9 trillion available. That's not what's invested. I saw the latest statistic that was invested on one of the earlier slides was it was almost 9 million, it was like 8 trillion. Sorry. It was 8 trillion, and we're headed towards even higher. And I think it was 2023, it was like 12 or 14 trillion, but there's still 9 trillion available with such an easy process. And takes us back to the point when we started the presentation started the discussion was, it's mainly because number one, they don't know that it's an option. And that's it. They don't know that number one, they can invest into real estate as an alternative investment. That's something that not only is approved by the IRS, there's several, and this isn't the right time, but I'll just mention, not only does the IRS approve of it, they give you so many tax benefits and tax breaks. They actually support it.
Mm.
So,
Right.
yeah.
Right.
And then
Yeah.
the other thing so the question I have is, you're right. I think most people, they leave an employer and like you said, they just we like to leave things where they are
Okay.
and it stays there. So my question is there a time frame? So let's say I left an employer 25 years ago.
Ah.
Is
Okay.
that money still available?
Excellent. Great question, Dino. So, so it should be, meaning that it's your money,
Mm-hmm.
it's not the employer's, and you've put it in, you've contributed it, and for whatever reason you left it there. So absolutely, the money, as soon as you leave the job, the money is able to come with you, and you can move it wherever you want. Um, so, very simply, yeah, it should be there. 25 years later, it should be there. Um, some companies, 401ks may want you to move things out at a certain point. Let's say, when you get to the distribution stage. So just back up for a second. So you have a contribution stage.
Mm-hmm.
That's any point up until you're 70 and a half. And then distributions can start coming out when you're 59 and a half.
Okay.
And when they absolutely have to start coming out, let's say 4 or 5% a year, is when it's 70 and a half. So when you're 70 and a half years old, you have to take money out. So there might be a 401k out there that would say, yeah, we don't want to have to make distributions every year with you. Just take the whole thing.
Right.
So that might be a reason to let it go. But other than that, it could technically, I would think a 401k wouldn't mind you leaving the money there. It gives them ability to make money with it.
Yeah. Exactly, because it's still right. It's not just sitting there stagnant. I mean, they're playing like you mentioned earlier. They're going through the cycles with it. Wherever it is, it's still out there sweating.
Right.
Um, I mean, do you think? And with that 9 trillion, where do you think
Yes.
most of this is sitting? Do you think it's sitting in accounts where people have left, or do you think that 9 trillion is sitting? Because, like you said. And I agree, when I've ran into this also with investors, it's like, okay, I have like 250,000
Right.
and they say I can self-direct, but actually that just means I can pick between like 20 different options and
Yeah.
that's self-directing. So do you think it's there, or is it sitting where people left employment? Where is it?
That's a great question, Dino. So there are ways to find out more of the investment choices that people have made. But I will say this, of the 9 trillion, I would say probably just 2%. That's whatever percent that is, whatever amount that is, it's just 2% of the money is in alternative investments. So that's generally the accepted number. I mean, maybe it's 3% now, maybe, but still, it's a tiny fraction of where the money is. Alternative investments, people have decided this is something they want, so they move over that IRA money and they get it.
Right.
The 97 or 98%. Well, we can name them. It's pretty simple. It's stocks, bonds, mutual funds, ETFs, and cash. There are many people just sitting on cash. They're nervous now. They've had a 10-year run, a nice bull run. It's been a great market for people that have wanted to be in the stock market. Great for them. But you don't know what's going to happen one day to the next.
Right.
And so the nervousness, the uncertainty, I think puts people into a more cash position, which is actually a negative position if you think about it, because cash, on the one hand, it's not gaining anything.
Right.
On the other hand, it's not losing anything. But that's not exactly true, because there's always inflation.
Yep.
There's always a cost of living that's going to go up, and there's always the time value of money, and all these concepts. So ultimately, it is a backwards move. It is a negative, although albeit maybe less negative than a total downturn in the market that you would experience. But still, it is a negative move by just keeping it in cash. So having it invested, certainly a wise thing, and there are many options to do that, short-term, long-term, outside of the stock market, if that makes anyone concerned to be in the stock market.
Right. Yeah, no, that makes sense. And like you said, they have been on a run. Things are kind of shaky right now. One of the things that I like about alternative investments, specifically real estate for me, because that's what I do. That's what I, eat, sleep, and breathe. And I'm not saying it's the only option out there. I mean, there's some people who just they play the stock market. They like the red and the green. There's people who love self-storage, love multifamily. Everybody has their own thing, and there's certainly more than one way to get a return on your investment. Don't get me wrong there, but I believe that over specialization is rewarded. So I think that if you're going to be a multifamily person, if you will, then it's good to be all in and, everything, know as much as you can about that and have a really good team in place. And one of the things that I like about it is, like you said in the presentation, it doesn't matter what happens with the real estate. On the first, rent is still going to be rent. Everybody signed the lease. This is what's going to happen. So you're not going to have the up and the down. And the other thing, you even talked about expenses as well when talking about the custodian fees or whatever the right word is. On as far as multifamily goes, there's so much that we can do, not only with adding value and raising the rent to market, or maybe even slightly below market is a really good business move, because you can keep your occupancy where you want it. But there's also the ability to manage it efficiently and control the expenses. You can raise your net operating income in many ways, but two of the main ones is bring in more money or spend less to operate.
Sure.
So there's a lot more control over what the operating team or can do, therefore the outcome of your investment. And there's less trends associated with the stock market. And like you said, I'm glad you brought that up. Even with the REITs, a real estate investment trust, it's still tied to the stock market. And you can say I'm invested into multifamily if it's a multifamily REIT, but you can't say, and I own a piece of XYZ building at this address. It's just a different ball game, if you will.
Sure. No, absolutely. And it absolutely is, Dino. You're absolutely right. And that's, intuitively, I've known this. Like, I kind of had a sense over the years that I've been doing the self-directed IRAs with people, and they want to get this asset, they want to buy these types of things. And I'm like, this is smart. This is really good. I mean, you're controlling this. You're empowering yourself to be able to do what you have researched and studied and seen that this is an opportunity. And not only that, either you're buying it yourself and holding it yourself, or you're giving it to someone like yourself that has a great expertise, a lot of experience, and a proven track record that shows, you're able to handle the investment for the client. So either way, either you're an active, do-it-yourselfer, or you're a passive investor that really can still have hands-on. They can come visit the site. They can, tour the property. They can, ask questions and be involved in the investment process versus just kind of, throwing the darts at the board. And hoping. So.
Yeah, and wishing and hoping for the best. I mean, yeah, and you bring up another good point. In syndication, so all of the investors, you have direct, or you should put it this way. The SEC says you should, especially if you're dealing with the 506B investors, sophisticated investors. They have direct access to us. Like, my investors have my cell phone. They have my email. They have the ability to go to lunch, or, you know what I'm saying? If they're local, or even if they want to fly in, you can't have that type of intimate relationship. I guess you could, but it's very rare for a CEO of a publicly traded company to say, sure, here's my cell phone. Call me anytime you have a question.
That's great. No, right. That's it. That's right. So I appreciate that. No, and I think that's what, to me, it means a lot, because now, so many people did not have access. And you could talk about the $100 millionaire or billionaire, and yes, he gets the personal attention and all that. But, the regular investor, regular retail investor, I've saved all my life. This is my life savings.
Yes.
I want to do something different with some of it. How do I do that? And no one really, not as many people knew about that until, let's say, 10 years ago. But now more and more. I mean, it's really a great opportunity, and I'm happy you're there. I'm happy we're here, and we can help a lot of people accomplish a lot more with their retirement money. So if you're okay, do we have another minute or two?
Yeah, go ahead.
Yeah. Okay. Great.
Yeah, you can say what you want. We can wrap it up, and then.
Okay. Great.
But I think this was a really great episode, and it's going to help spread the word.
Thanks. I appreciate it. So I wanted to just share a little bit more about Madison Trust. We're just, when we talked about the opportunity, we did kind of sort of show one option of custodian type to another. We just want to tell you where Madison falls on that spectrum.
Right.
So, but, you can be informed and make an informed decision if we're the right company for you. So in terms of our foundation, the main thing we started out with was customer support. We felt that is the key to our success. Nothing else, no matter, how much you charge, or, not even sometimes how fast you do things. It's really because, a lot of mistakes happen when you try to rush. It's really, how do you take care of those clients? How do you treat those investors? And, we're friendly, we're professional, and we're efficient. I think that really wins the day. And ultimately, we've seen it, because many of our investors, the clients that we do have come over to us from other custodians. And really, I think it's telling, because our service is first. It's the customer experience, a world-class customer experience. Not to mention, the low fees, and we make it easy for you. And we have a dedicated person to help everybody who comes on board. And And by the way, we answer the phone. That's an unusual thing today. We, have a lot to talk about. We've got 1.3 billion under custody. We're regulated, and of course, an A+ rating with a BBB, and 100 different kinds of investments we've experienced with. So it's very good in terms of, who you're working with. It's good to know that, there's a lot of background that we have, and not just the 5 years of Madison, but also the other 5 years of Broad Financial as well. All that experience is coming into this and giving the investor the comfort of knowing they're dealing with a very experienced provider.
Yeah.
In terms of cost, not much. It's $50 to set up an account, and it's $60 to keep that account going. And then just to invest in something, it's another $50, and that's basically it. I mean, if you want to have a wire fee, that's $25 to wire money in to Madison from, let's say, the old custodian, and then $25 to wire it out, let's say, into Edified Equity or wherever it's going to go. So that that's it. Other than that, there are really no other fees. Yeah. So I want to give everybody my contact info. So here it is. My phone number is 845-947-1717. And again, it's Jay Goldblatt from Madison Trust Company. And it's, again, 845-947-1717. And for those on the podcast, for those who are watching the video, you can read yourself. And my email is jay@madisontrust.com. So
yeah. Well, thank you. That's how I was going to close out and say, how do we get a hold of you? So what? And all these links. I mean, if you're on the podcast, it'll be in the show notes, as well as you can always zoom back over. I think you can listen. This is something you can listen to while driving or running or walking or even going to sleep. And you can always, if you want to see the slides, which I recommend, it always helps. You want to go to the YouTube channel, you can catch everything there. It's not going away. But look, just like we do here, I don't expect listeners to ever invest into any of our syndications. We definitely don't do any. Actually, we don't do any public offerings. Everything is private, so you're never going to hear us, quote unquote, pitch a deal, if you will, or ask you to partner on a deal. We're here, Jay and I both today are here to give education and educate people on what I consider a phenomenal alternative investment, like we talked about, that the operators have control over. And then again, in a vehicle that is underutilized. I mean, if there's $9 trillion out there and only 2% are in alternative investments, and that includes all the alternative, not just real estate, there's so many out there. And the number one reason I always answer, either on a podcast or as a guest or in an article, why aren't more people doing this? The same, you even had it in your slide. You're like, why is this the first time I hear about it? And that was more about, well, the person you're working with incentivized differently. But anyway, the reason is because you just haven't heard about it. So we're getting the word out, letting you know. If you have questions, feel free to reach out, of course, to me. But if it's questions on the IRA side, Jay is the better person there. He's the expert. So let's close it out. This was a great episode, and I hope you all found this information helpful. So whether you're here for the education, entertainment, if you or someone has a problem finding the right place to invest their money, please help them by sharing this information. I don't have anything to sell, but I am on a mission, and I will continue to deliver quality, consultative, educational content on a routine basis. Thanks for tuning in. Make it a great day. You certainly deserve it. Jay, thanks for coming on the show.
Thank you so much for having me, Dino. I really appreciate it. I enjoyed it.
You're welcome. This is Dino Pierce, CEO of Edified Equity, signing off. Goodbye.